Despite the challenges we have all faced in the past several years, 2022 turned out to be one of the most challenging years of my career. The main headlines on December 31st was, "Stocks had their worst year since 2008. While that is certainly true, there's more to the story of 2022, and today I want to spend some time recapping some of those highlights and some of the challenges that all investors faced in 2022. Supply chain shortages continued to wreak havoc with products and services and became a big challenge for the United States as well as many other countries, then followed by the challenge of the war in Ukraine that sent energy prices skyrocketing. And as uncertainties around the midterm elections continued, so did the economy. If I were to summarize what 2022 economic conditions were like, it would simply be centered around the Federal Reserve, reversing their course of action of what occurred during the pandemic. If you recall, the Federal Reserve, as well as the US government, aggressively used their tools during the pandemic in 2020 and 2021 to jumpstart the economy as a result of shutting down our economy at the beginning of the pandemic in 2020 and continued through 2021. Their actions not only worked well, but they worked so well our economy started to overheat in 2022. And as a result, the Federal Reserve used almost all of its tools to slow the economy down in 2022. As a result of this overheated economy, according to the U.S. Bureau of Labor and Statistics, inflation peaked in June of 2022 to 9.1% on a year-over-year basis. To put that into perspective, the year-over-year increase in inflation for 2021 was 4.7%. We haven't seen the final CPI numbers for December, but in November, the year-over-year inflation was 7.1%. With supply chain shortages in 2021 and into the beginning of 22, the Federal Reserve felt inflation was transitory. When the Federal Reserve realized it was not transitory, they started aggressively hiking rates in March. At the beginning of the year, the Fed funds rates were at 0.25 and finished the year at 4.5%. This is a significant increase from the original estimates at the beginning of 2022 of 1.25% to 1.5%. The other tool that the Federal Reserve has used in the past is their bond buying program, referred to as quantitative easing. In January of 2020, prior to the pandemic, the Federal Reserve's balance sheet was slightly over $4 trillion. And by April of 2022, the Fed's balance sheet had peaked at almost $9 trillion. While the Federal Reserve has not sold any of their bonds that they purchased, they're letting their bonds run off their balance sheet once they mature. The current balance sheet is now at $8.5 trillion. This has impacted both the Treasury market and the bond market, sending interest rates sky high, as well as sending mortgage rates significantly higher. According to the Wall Street Journal, the yield on the 10-year Treasury closed on December 31st at 3.82% from a yield at the beginning of the year of 1.49%. This significant increase in bond yields took a toll on the overall bond market. In fact, for 2022, the Bloomberg Aggregate Bond Index lost 13%. In addition to the bond market losing 13%, mortgage rates had a significant impact by impacting homeowners or buyers' ability to purchase new homes or refinance their existing mortgages. On January 1st of 2022, the average 30-year mortgage rate was 3.22. By the end of the year, the average mortgage climbed to 6.42%. To give you an idea, for an average homeowner with a $300,000 mortgage, the principal and interest payment at 3.22% is $1,300 per month. But that same $300,000 at 6.42%, the principal and interest payment would be $1,900 a month, or almost $600 per month more, for an additional amount of a total of $7,000 per year. On a positive note, according to the U.S. Bureau of Labor and Statistics, the overall job growth in 2022 was 4.5 million new jobs that were created, bringing the unemployment through the end of November down to 3.6%. Despite the strong labor market, the threat of a recession through last year and into the following year, 2022, remains strong and have weighed very heavy on the stock market. As a result, the U.S. stock market, as I mentioned, had its worst year since 2008. The S&P 500 was down 19% for the year, while the Dow Jones Industrials dropped 8.8%, and the NASDAQ, with heavy weightings in technology, lost 33%. All three of these indexes logged their biggest decline since 2008. So as you can see, 2022 was certainly an unusual period of time. In summary, when you look back on history, things tend to go in cycles. This cycle was the Federal Reserve and the U.S. government helping us get our economy back on track after having shut it down in 2020, creating a supply chain shortage and ultimately real inflation like we haven't seen since the 1980s. As a result, the Federal Reserve has aggressively raised interest rates, started unwinding their balance sheet, which ultimately sent bond prices lower and mortgage rates higher. Concerns over U.S. economy going into a recession has also sent stocks lower. While the events that have occurred in 2022 seem unusual, we've gone through similar cycles in the past, and when the dust all settles, I believe we will look at this period of time as just another cycle in our economy.